All right, so I'll be quick. It's good to see a lot of familiar faces in the room. Thanks for joining us tonight. So a few words on Falco Resources. This is a company that the Osisko Group has been involved with since 2015. What we did, well, 12 as a founder of the company, but we really refocused on the company in 2015 after the sale of Canadian Malartic. Most of the engineering team, as you're going to see, ended up joining the Falco project, and since then we've been moving the project along quite rapidly. As you can see on the first page here, we've completed the feasibility on the project in November last year, so you could see a sketch of what the final product will be once it's built. But essentially, it'll be a very, very compact site in the middle of a mountain mining town to the north this time, so we don't have to move any houses like the first time when we built Canadian Malartic, which is a good thing. The only thing we have to move essentially is this building here that we're going to be reusing is a trade school, which we're already relocating. I'll show you a picture later down the road. But if you went to the project today, you would see most of these buildings here. But all of this here is basically vacant land and will be built in the future. A very disturbed site. This mine was in operation from 1926 to 1976, so it was in operation for 50 years. They mined essentially 11 million ounces of gold and 3 billion pounds of copper. So this was a very, very successful mine in Canada, one of the biggest mines in Canada and also one of the biggest mines in the world. But as you can see, a very disturbed site. You could see tailings here and around our site and the polishing pond. So from a permitting point of view, we don't expect to see too many challenges from a government point of view. Where we're at today, at the moment, we're at $147 million of market cap. We have about $25 million in the bank. We have 6 million ounces of gold resources only on the reserves, and then we have another 2 million ounces of inferred as well. So in a sense, what we're looking at when we finished the feasibility in November of last year, what the project gives us at the moment is a 15-year mine life with average production of about 220,000 ounces a year at a very, very low cash cost of $399 an ounce. The reason why the cash cost is so low is because we have a very high byproduct credit from copper, zinc, and silver. So we have about 67% of our revenue that comes from gold, and the rest is from zinc, copper, and silver. To put it in production, we're looking at a development capital of about $800 million in capital, US. The most important thing for a development company today is to have, yes, financing, but also the proper team to put it in production. It's one thing to have a great project. If you don't have the team to put it in production, it's very difficult to move along the steps. What you see on this slide here is everybody with a star next to their name is somebody that was very significant in the mine build of Canadian Malartic when Osisko Mining built Canadian Malartic the first time around. So we have a very, very experienced team. The president is Luc Lessard, who was the CEO and VP construction of Osisko Mining when Sean and John built Canadian Malartic. And then everybody from Ronald Bougie, Hélène Cartier, François Vizina, and Christian Laroche were all instrumental on the operational side and on the construction front. So that same team is doing the same thing with Falco. And when Sean talks about the Accelerator Models or companies, there's obviously Falco, there's Osisko Mining, there's Osisko Metals, and also Barkerville. Most of that team here comes from the engineering front. So from an advancement point of view, we've completed feasibility. We're now looking to do the financing and then put it in construction. So we're very advanced on that front. Obviously, the market is somewhat challenging at the moment. We're trying to do the best of it, and we're also trying to leverage our relationships from a financing point of view. So that means obviously talking to groups like yourselves, but also talking to the governments, talking to the different pension funds all around the world, and leveraging our relationships that Sean and the team have been able to take care of over the last few years. You've seen the same slide here. This is the blow up, but obviously you see in the northern tip of the town of Rouyn-Noranda. You're in Quebec, very safe jurisdiction. The most important thing about being in Quebec is obviously you have very, very stable jurisdiction, very stable permitting timelines. So from our perspective, we believe that 12 months from now, we will have that mining permit in hand to build and start construction. And also, it's probably the only place in the world where the government actually pays you to mine, to build mines. So we expect to see $150 million, you know, plus or minus 25 million of investments from the government, both on the equity front, but also on the debt front. On the latest mines that were built in Quebec, the latest one being Renard, there's the diamond mine. We saw the Quebec government come in for $325 million out of a capex of 900. So a very, very strong support from the Quebec funds. In terms of the deposit, as I said, this mine was mined for 50 years. So they mined the first 600 meters. What we're looking at for the feasibility is essentially from 600 meters down to level 47. So we have 15 years of mine life here. But most importantly is there's probably another 15 years here. But the feasibility only accounts for the top part here. It's a big VMS system, so very, very contiguous. It's basically 2 kilometers deep, 800 meters in strike, but it's also 120 meters in thickness. So very, very thick ore body, very easy to mine. In terms of the resources, as I said, on the reserve front, we're looking at 80 million tons plus another 21 million tons on the inferred. So very, very big resource and reserves. And at that point, at the moment, the head grade right now on PNP, we're looking at 2.4 grams underground. So it's going to be a big, low-grade, high-bulk tonnage operation, very mechanical, the highest technology and the best technology in the world in terms of very big automation and very state-of-the-art trucks and equipment. So the feasibility, we touched on it earlier, but essentially we're looking at a very, very big mine, targeted construction start for essentially 12 months from now, and we would see first gold in late 2021, early 2022. Bit of the same, so I'll skip this. As I just touched on, essentially the feasibility, the first 15 years of mining is in this area here. The interesting part about the Horn mine, because it was mined for 50 years, they did a lot of development before shutting down the mine. And the main reasons why they stopped mining at this mine was because the top portion of the mine was 2% copper, and as you went deeper, it became more of a precious metal deposit. So they wanted copper because they had the copper smelter, which was on top, which still runs today. But as they went deeper, they found more gold and more silver, and they didn't want that. They wanted copper. But before shutting down the mine, they developed 20 different levels. They actually had 2 internal shafts, 2 winds that went down to 2.4 kilometers. And as you can see, all this gray area here is all historical drilling that was done before shutting down the mine. So we were able to recuperate a lot of this, this data from the archives underground. And we essentially were able to model this. And beginning in 2015 and 2016, we did a lot of confirmation drilling on this. And last year, in 2016, we did the first PA, and last year we completed the feasibility. So this is very, very fast in terms of when you look at a timing of putting a mine in production. You talk to anybody in the sector today, and anybody will tell you it takes about 10 years to put a mine in production, from the first drill hole to the first gold pour. Right now, we're 3 years into the development of this project, and we think we're 3 years away from production. So we're right at midpoint. We're at 50% completed. We think, as I said, we'll be in production by 2021, so that brings us 3 years. So that means we put the mine in production in 6 years, which is tremendously, very, very fast from a mining point of view. The most important thing also to remember about this mine, it's going to be a very big mine. So it's going to be very big stopes. You're looking at 40 meters high by 25 meters by 20 meters deep. So these are going to be very, very obviously big stopes, but highly mechanized operation. You're going to see a lot of big trucks, and it's going to be systematic. So everything will be fully automated. That means your truck is running 24 hours a day. Every single second counts. So it's all about bringing as much rock to surface as possible. Bringing rock to surface requires a shaft. It's a good thing. 600 meters away from the deposit is a 1.2 kilometer shaft that's already in existence today. We're going to have to dewater the shaft and refurbish it, but we don't have to sink it. So that saves a lot of time and a lot of capital as well. So a bit of the same thing, but essentially we'll be using this shaft here, which is 1.2. So this is a mirror image, so the shaft is on the other side. But essentially it's 1.2 kilometers deep. We're going to start mining here in year 1. We're going to be mining up, and during year 7, we're going to be deepening the shaft down to 1.8 kilometers and mining the rest of the deposit in phase, which should be called phase 1A and phase 1B, but this is only 15 years of mine life, and then you have pretty much the same thing below it that will bring you to another 15 years. As I touched on earlier, big trucks underground. So these are the biggest trucks possible underground today, and everything will be automated. And you're going to have the capability of driving these trucks from surface, and that what that means is you get a lot more efficiency and a lot lower costs from a mining point of view. This is the traditional schematic of an underground mine. So you have a lot of shutdowns during the day because you have to do blasts. You have to get your personnel up on surface when you do the blast. You have to evacuate the gases. And then once that's done, your personnel goes back down and keeps mining. With these trucks, which are fully automated, you're able to operate the trucks even though you're blasting. So that's why you're getting a lot more ore to surface, and your costs are a lot lower from a mining point of view. So these are the mines of the future. This is what everybody is looking at. It's big bulk tonnage, systematic, a lot safer from a mining point of view because you have a lot less people underground. So these are truly the mines of the future. Kidd Creek is using it, so that's Glencore, Petra Diamonds, North Parks, Rio Tinto. A lot of the majors are using this technology, and you can see the increase in productivity and also the decrease in cost per ton. So these are proven technologies that we're going to be putting in place. And that translates to very low all-in sustaining costs. So once we're going to be in production, we're going to be obviously very, very top quartile asset. And you can see here the byproduct credit from the copper, the zinc, and the silver. It's going to be a big CapEx, not unlike Canadian Malartic was when Osisko Mining, the first company, built the company. It's going to be $800 million, the majority of that being spent on the processing plant. But the way we see financing this, and we touched on it, I think, last time when we were here in November, but the government should be participating for somewhere around $150 million. There's a contract between Osisko Royalties and Falco whereby Osisko Royalties will be able to participate in a stream financing as part of the project financing. So we think that goes from $150 to $200 million for the silver component. And then we will be looking at ECA, so export credit agencies for the equipment in terms of the mobile equipment and a few pieces of the processing plant. So we're looking for $100 million there. So that brings you close to 400. And then the rest of the 400 will be split between traditional debt and traditional equity. So when you start piecing that financing together, by being able to leverage our relationships, this should be a financiable asset, especially if the gold price all of a sudden starts ticking, which we're all hoping on. As I touched on, we had to relocate a school. We're already building this. We should be able to give the school back to the community in June of this year. So this was a pretty big operation that we had to do to obviously have the proper license to operate at the project level. So this will be done by June of this year. But this will also be used as a center of excellence for those automated trucks that I showed you. Everybody will be trained in that facility. These are comparable operations in the area, from most of them from Agnico, La Ronde, and Goldex. Very high bulk tonnage operation, just to show you that low-grade operations in Abitibi are common, and people make a lot of money with those. So in terms of what we did and what we're doing, we've completed the PA, completed the feasibility. We've deposited the environmental impact assessment with the government in December. We've just received preliminary comments. We'll be responding to those questions. So we should be able to publicly release the EIA within the Q2 or early Q3, which would bring us to a first permit in terms of construction and mining permit by 12 months later, so by mid-2019. And that would essentially fit well with the start of construction, which we believe should be in mid-2019. In terms of valuation, we're at 0.2 times NAV versus most of the other developing peers. One of the major issues that we're dealing with at the moment is that we require a license to operate from our neighbors, which we'll call them that, which are on surface. It's Glencore. They operate a smelter on top of the deposit. Glencore sold us the asset in 2012. And essentially what happens is we have two things we have to answer to before they grant us this license. So one is the technical front. We have to share everything from a technical point of view with Glencore, which we've done throughout the feasibility study. The second is we have to show them that we have the necessary financial and insurance package to protect in the event that there were lost time incidents at the smelter. We're now dealing with that second part. We're almost done. We're advancing those negotiations very rapidly, but that explains a bit of the undervaluation at the moment. But that also creates a milestone in the future. The minute you see that come out, in terms of that piece of news that we've resolved that issue, if it's not a double in the share price, I don't know what it is, but there's obviously going to be a lot more upside from that point of view, because from that point of view, it unlocks a lot of value. So keep that in mind when looking at Falco. On the other front, obviously the financing at $800 million is taken into account, but remember, you're in Canada, you're next to a mining town, and you have the right team to put it in production. So we're taking all those risks into account. What we're doing also this year is we're spending $800 million on exploration. So we're 800 capex, 8 million. So we're going to be spending $8 million in exploration on the extension of the deposit. So the deposit sits below, you can see here the smelter operation. So our deposit is below here, but we're going to be drilling an extension this year. So we expect to see some good results. You can see here, this is our deposit, but the extension here was never really drilled because of the lake in this area here. So we expect to potentially see some upside at depth. And other than that, I'll close on this, this will be my second last slide, but the other operation that I talked about, La Ronde, which is operated by Agnico, they've been operating this operation for 22 years. So when I say that we have a 15-year mine life here and probably another 15 here, is when we compare to this operation, which is only 30 kilometers away. They've been operating this for 22 years. They're now mining at 3.2 kilometers below surface, and they've been hitting at 3.7 kilometers below surface. And they have the similar trend as us. We have a gold grade here of about 1.4 grams per ton, but at depth in this area here, we're at 3.4. So as we keep on going deeper and deeper into the deposit, our gold grade actually goes up. So that's where we have a lot of upside. And we'll be drilling this area here once we are underground, because it's way too expensive to drill these areas at the moment. So keep that in mind. Also, a lot more upside at depth. In terms of their shareholders, obviously Osisko being at 13%, Tocqueville, the government of Quebec at 5%, Oppenheimer, and at the moment our stock's about 75, 78 cents, with about 20 million, 25 million in the bank. So on that note, I'll close it and open it for questions if there are any. No questions?